Okay, so I'm starting. Try to be as quiet as possible. Okay.
Are we leaving that in, or?
You can if you want. Hit it.
It's Friday, August 1st, 2025, episode 269. I'm Patrick Serezna.
And I'm Kevin Muir.
Kevin was having such a good time with the guest that he forgot to record the very important part of the intro. So, without further ado, this week we welcome to the show Robert Mullen, founder of the Marathon Resource Advisors. They have a terrific discussion about why Liberation Day decline was one of the largest VAR shocks in years and how Robert is positioning his portfolio to protect against the changing macro environment. Stick around.
And then this week, it's Talking Charts, where Patrick gives us clues as to whether the stock market decline is a one-off affair or something with legs.
Well, there you go. And folks, stick around. Well, we were supposed to be drinking beers. I literally pulled out a Corona. This is getting so lame, Kev.
Yeah, no,
I
know.
We had a reputation to maintain as Canadians. We built this entire show about having a couple of beers and shooting the shit on the markets. And you have.
I take responsibility. Yep. I got my concussion and I stopped drinking, and I've been just a complete mope since. And we thought, mope. We got an Englishman, to help out here, and we thought he would do it. He's mopey,
and he's been a mope too.
Yeah. So folks, guys, what's our promise? That we're going to be come September, we're going to get our acting gear.
We're going to get back. We're going to get back in the way that we've done it in the past. We're going to feature some kick-ass beers.
Yeah.
I think we go full alcoholics.
Oh, really?
I think we go. I just think we do it.
You mean
no?
We're recreational alcoholics.
Yeah.
Functioning. Yeah.
Functioning. Okay.
Yeah.
All right. Kev, give us a disclaimer, buddy.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include the payroll panic disorder.
Mm-hmm.
Yeah. Jobs jitter disorder. Those are two different disorders. They're very similar. And then finally, the risk-off reflux syndrome.
Yeah.
Something as you get older and get a little fatter like me, you experience a lot more.
Absolutely. Gotta watch what you eat. All right. So let's get the guest on.
It's our great pleasure to welcome to the show Robert Mullen. He is the founder and chief investment officer of Marathon Resource Advisors. Robert, thanks for coming on the show.
Hey, awesome to be here. Really appreciate you having me on.
I'm actually really, really looking forward to this because I watched an interview you gave, and you spoke a lot in terms of from a macro perspective about the changing correlations between stocks and bonds, between U.S. stocks and U.S. Dollar. And we're going to get to all those great things. But before we do, I would just love to get to know you a little bit better. So why don't you tell us a little bit about yourself, like where you come from and how you ended up here?
Sure. Well, as it's, relevant to how I ended up in this seat and doing what I do, I'm the child and oldest son of a stockbroker from the 1970s and 80s. My dad got into the business with the original E.F. Hutton and Company. And so as both oldest child and namesake, he was Robert Mullen Sr., it was always an area of interest to me. And so I grew up, as a 7th or 8th grader talking about stocks and, paid a lot of my way through college with, I can't say it was all my astuteness. He certainly helped out a lot, but my college was, mostly covered by a prudent investment in Amgen, the biotechnology company, way back in the 80s.
Wow.
So
wait, stop right there. So you were like a young kid and you decided to buy some Amgen. And for those who don't know, that was a big high flyer in the late 80s, early 90s. Tell us the story. I'd love to hear like what you did and how it evolved.
So my dad thought it really important that we become, as a whole family, financially conversant. And as his business was picking stocks, he later got mostly into management. So he managed brokers, eventually the kind of West Coast, from Hutton through Shearson through kind of Smith Barney, et cetera.
Right.
But we were always engaged in what we owned, and it wasn't mutual funds. We were buying single stocks. And so if I would see something in my real life. Like I thought Revo glasses were very cool. And so we looked and figured out what company made those. And I think it was Serengeti Eyewear or something like that.
Okay.
So we would do real world. Do you see it? Do you want it? So I can't say that Amgen was one of those. As a 14 or 15-year-old, I certainly wasn't saying, oh, I think these, they will have these drugs that will change the way people think about their health. And but it was one of those things that, even though it was one of 7 or 8 stocks that I owned, when something goes up 40 or 50 fold, all of a sudden, you get a real understanding for how financial markets can work in your favor if you find things at the right time. And modest ideas become really big ideas.
Wow, that's terrific. All right, so you go to university. Where do you go? And are you already at this point thinking you're going to be in finance?
Yeah, I was always leaning that way. Also, my mind always worked kind of mathematically. That was always my strong suit. And when I took, I don't know if this, probably dating me, but people did Johnson O'Connor tests, where it was aptitude testing. So it gives you 40 different tests, and it tells you what your mind is naturally inclined to be good at.
Right.
And what that test told me is that if I had been born before 1940, I would have been a code breaker for like World War II. The way I mathematically could do number series and things like that was just, I was bad at plenty of stuff. Never going to be a surgeon because I was fumbling the little pegs all over the place. But that was something that my mind naturally gravitated to. So the combination of nature and nurture got me to knowing that the financial markets were where I wanted to be. I did a couple of internships at EF Hutton in college during my summers. And so, that was always the direction. So I went to the University of Colorado, got a degree in economics with a business emphasis, spent 4 glorious years in one of the prettiest cities in the country. And came out, backpacked around the world for a year, as it was 1991, and there wasn't a great job market for those in finance. And my parents actually felt very strongly that helps you build perspective about, and back in those days, backpacking around the world, the internet was really early days. So in order to figure out where you were staying when you went to a new city, you had to read books, you had to get on the phone, you had to sometimes just show up and knock on doors and see if people had beds available. So
did you do that alone? Did you do that alone?
I had one friend with me. And the two of us backpacked around the world for just under a year.
Wow.
Visited
what was the highlight? Like, what was the surprise hit that you weren't expecting?
So I loved Eastern Europe, Czechoslovakia, Hungary, and Poland.
And this is just as the wall's falling, right? Like you're there at a very pivotal time in history.
Absolutely. And look, they loved Westerners and blue jeans, and you show up, and even if you're a relatively unimpressive guy like myself, you're kind of a rock star because they're like, they all watch Dallas and they all watch all that kind of stuff. And having grown up on my mom grew up on a West Texas cattle ranch, which is where the Marathon firm name comes from. I could actually talk the cowboy stuff as well. So that was great. So Eastern Europe was a real revelation, and just, cheap as chips and really fun to go around. Wonderful, like jazz bars in Prague, etc. So that was a highlight. The beaches in Thailand were amazing. And so that was a real highlight. We actually took some time to go from Hong Kong into Canton. So into mainland China at a time where not a lot of folks were doing that. So that was a pretty remarkable, eye-opening thing. South Island of New Zealand, the thrill seeker capital of the planet, where you could spend a day doing nothing but, jet boating and bungee jumping and river surfing and all kinds of stuff. It was there were lots of highlights.
That sounds like a terrific trip. Okay, so you come after your year of going around trying to find yourself. And when you weren't in that country, you went and checked another country, and you weren't there, so you still went to another country. But you did eventually find yourself in terms of what you wanted to do. Where do you come back and get a job? Like, do you go to Wall Street?
Yeah, so I had thought about that. And as I was going around, when I was in New York, I had interviewed with both investment banks and some of the bigger consulting firms, thinking that was a direction I may go. I did the same thing in London. And eventually I was like, look, the Bay Area is a pretty good place. I grew up, just south of San Francisco, down in kind of the Palo Alto area. And so I was like, I came back here. There's a good asset management kind of history out here. And so I went to work for the Franklin Templeton Group. And
Okay.
so I managed to sort of come into their management training program, spent a year kind of bouncing between different departments, and then eventually got pulled in to work in the portfolio research department back in, gosh, I guess I was like 94.
Oh, that was a terrific time and a terrific place to be for the .com bubble.
Yeah.
You had a front row seat. Tell us about that.
Oh, living in San Francisco during that mania was something truly to be seen. The pervasive bullishness about the possibilities of what the internet would deliver were just boundless. And when I'm cranking away, and I think my salary at Franklin was like $35,000 a year or something like that, and I'm seeing people, some of my peers on paper, go to easily 7 figures net wealth, which was a big deal, for a 23 or 24-year-old back then. It was remarkable. It was one of the most fascinating front row seats in the history of capitalism. What really shocks me is that it seems like we're getting these echo booms, which we did in kind of the late 2010s. And now, look, again, today with what's going on in a combination of AI and crypto, it's similar in terms of tone. It's just you've had to add a couple of zeros to what is. Yeah, at least it's it's an order of magnitude bigger in terms of the impact that it's having in the financial markets.
And I look around, and to me, it feels almost exactly the same. Like I think given when you graduated, we're about the same age. Like I was born in 1970. And so I was a young guy on the trading desk in the late 90s. And I remember people telling me the same lines that they're telling me today. Like, oh no, you don't understand. It's going to change the world. Prices don't matter. And they say the same things about AI. And I'm just like, oh, I've seen this before.
Yeah, suddenly financial alchemy, which I think is a lot of what we're seeing today and can be applied to several things. I sent you a little chart beforehand that I meant to tell you about how people are cognizant about private credit and how it's being qualified there. But there are so many places where it appears like financial alchemy is being applied to create end realities or risk return profiles that seem to be well outside what history would tell you they should be.
Yeah. Well, Saylor with his Bitcoin thing, you're issuing stock at a premium to buy more Bitcoin. It's like a self-fulfilling kind of, positive reinforcement loop. Like it's crazy.
Well, and if not only you can do it, but 140 other companies can do it, and not just with Bitcoin. It's like, look, Fartcoin's about $1.5 billion market cap here. So,
come on.
So Kevin,
how about what?
Yeah. So, but you and I, if we corner the Fartcoin market and put it into a Fartcoin treasury company, it's probably worth at least $5 billion, right?
I was joking and saying somebody, or no, actually, I didn't come up with this. One of my buddies said they should make a treasury company of treasury companies. And then I was like, what premium do you apply on that? Is it a multiple, or is it actually exponential multiple you should put on in terms of a premium? Because it's
for those of us that went through the .com bubble, this is the equivalent of like the internet capital in CMGI, which was the public way to buy venture capital within the technology markets, which all of a sudden traded at, 7, 8, 1,000% premiums to the written up values of their underlying holdings. So look, history never changes. It just rhymes. It repeats itself constantly, right?
So you're there. How long do you last at Franklin, and what's your next step in your career?
Yeah, so I was there for, so management training program, portfolio research. I helped convince them, along with one other colleague, to launch a natural resource fund. They had a gold fund, one of the oldest gold funds in the business, but they did not have a resource fund. And so we convinced them to launch it. So that was late 95, I guess. Okay. And I was a co-manager on that fund until the end of 96. And I got an offer from another investment professional in San Francisco who said, look, I've shared a lot of meetings with you. I like the way you think. I'm running a little hedge fund. Why don't you come join me? So at the ripe old age of 26, I jumped out of the safe bed of Franklin and launched my own hedge fund in a time when, it wasn't like it was unknown, but it was not nearly as well known as it is today, and certainly a very different character in terms of how people thought hedge funds ran money.
Oh, for sure. It was the old days of people thought about Soros and Steinhardt and all those guys and swinging for the fences. And we yet didn't have that idea about the kind of 1% a month and low volatility, right?
Yeah, it was genuinely risk takers, as opposed to what I think is a broader theme today, where it seems like people are trying to systematically eliminate or eradicate volatility from every facet of their portfolio, which I think as we all know, it's like inherently that doesn't work long term.
Right. Okay, so you've been doing this for since then. So let's talk some markets. Why don't we just start with what I highlighted at the top of the show, which was this idea that you've been talking about the risks inherent in the fact that correlations within the market is changing. And I would just love to hear your thoughts there. I thought a lot of it was just brilliant.
Thank you. So let's start with how kind of bonds interact with stocks. And I think what people knew from 2000 to 2020 was that bonds were a wonderful anti-correlated asset to equities. And during those series of years, your upside bond moves would eradicate or offset a significant portion, if not all, of your downside volatility in equities. But if you zoom out and look at 120 years worth of bond stock interactions, what you see is that for the other 100 plus years of that relationship, that bonds and stocks are typically kind of either uncorrelated or positively correlated. And the real driving variable on that is inflation rates. And so if inflation is north of 2.5%, equities and bonds become more correlated. And so, yes, in the 2010s or 2000s and 2010s, they were anti-correlated because that low level of inflation gave the financial authorities, central banks, et cetera, the leeway to be able to be massively stimulative every time you had a broader market correction. So it gave them license, it gave them cover to be able to do that. What we saw in 2022 is that it's a lot tougher to do that when inflation is running high. And so that's kind of the origin. So this sort of run to the 60-40 portfolio is the greatest fall. It's based on 20 years of financial history, which is really more the anomaly than it is the main the main story of what you look at in 100 plus years of asset performance. So you take that a little bit further, and you also have this period that's been very strong dollar. And I think that combination of U.S. markets outperforming dramatically and this U.S. bond market has gotten huge, and it was the great hedge, and you wanted to own the dollar and own U.S. stocks and own U.S. bonds, created an environment where folks just got, non-U.S. investors got really, really overweight. Not only did they let their U.S. component of their portfolios grow organically because we were outperforming everything else, but they were adding more money in. They were selling local to buy U.S. And that worked spectacularly well. They wanted to leave particularly their U.S. bond portfolio, but even their U.S. equity portfolio uncurrency hedged, because that was the part that really helped them in corrections. Not only did U.S. bonds perform well, but the dollar rallied. And so, the kind of big macro point that I tried to drive home in the analysis that I did back in April, post the tariff tantrum, was that if you look at the VAR shock that global non-U.S. investors took on their U.S. assets. And I went into this saying, God, what I think it was like Le Shrub, coined the term Klaus. So I just said, what is this comparative to? And so I compared it to the GFC.
Right.
In the GFC, you had 18 months where markets around the world got smoked. And their drawdown on roughly $10 trillion in U.S. asset exposure in local currency was about $1 trillion, so about a 10% drawdown over 18 months. Look at what happened in the tariff tantrum earlier this year, and you had about 2 months where 47 trillion in U.S. asset exposure dropped by something close to 10 trillion. So on a performance basis, you had in 2 months a 20% drawdown versus a 10% drawdown that happened during the entire GFC over the course of a year and a half. But the dollar amount was 10 times larger because of the growth of all assets over that period of time. So look, you and I, and probably a lot of the people who listen to this show, they manage portfolios and they try and quantify risk. And if you have a piece of your portfolio that grew into a really outsized position because of what you perceived was a low drawdown potential in a crisis, and all of a sudden it's not a low vol asset, it's a high vol asset, you have to change the way you allocate your portfolio. And so I think, and look, I heard you talk about this on, with Adam Taggart. I think this has started a long-term trend. And look, these foreign institutions move like molasses. It's turning an aircraft carrier. The investment committees aren't even meeting for another, couple of months until we get out of August. So, I think over time, what they're saying is, and what any good portfolio manager would say is, gee, we've gotten way overweight this. It's not acting like it has historically acted. Yep. We just kind of need to own less of it. And, or we need to own things that genuinely help offset that volatility. And so I think that's why gold is doing what it's doing.
Okay. We'll get to gold in a sec. I just want to go back and just make sure that everyone understands what you're saying. Because when I heard you talk about this study you did, and I wasn't aware of it, it was mind blowing to me because I was shocked that the numbers were this large. You said on a percentage basis and in absolute dollars, the hit to a foreign investor was less than this Liberation Day hit. And let's just explain to people why that's the case. During the GFC, the dollar rallied a lot. So when you were long US equities or US bond, or in fact, I guess it was even worse in terms of if you owned treasuries, the negative correlation helped you there as well in terms of the US side of the thing. So it was like correlations were your friend in the GFC as a foreign investor. You owned US stocks, US bonds, and you were unhedged. So your bonds were doing well as long as they weren't risky bonds. So that negative correlation helped you there. So it offset some of your losses in the U.S. stocks. But most importantly was that the U.S. dollar went up during this period. So your hit was around 10%. And in terms of absolute dollars, it was $1 trillion on $10 trillion of U.S. assets owned by foreigners.
Exactly. You had pistons moving in opposite directions.
Right. Contrast this to the Liberation Day. And this is something that I have been writing about, and I don't think enough folks give it enough credit, is the fact that not only did you have the U.S. stock market and U.S. bonds going down together, but you also had the U.S. dollar going down together. It was the absolute nightmare scenario in terms of foreign investor that owns U.S. assets. And so if I got the number right, it was 48 trillion. They lost about 10 trillion. So they lost 20% as opposed to 10%. And even though
in 8 weeks versus a year and a half. So it's not just the size of the drawdown, but it is the rapidity of it.
Right. And you also highlighted this so well in that you said like nobody is done anything yet, because the reality is that these investment committees, these consultants move slowly. And I was actually in London, and I'll just give a quick story in terms of like I was at a fancy dinner and everyone was talking about their portfolios, and there was guys way above my pay grade, and they were all kind of laughing about the fact that they all expected the US dollar to go down. And then when you asked everyone what their positions were, nobody had sold US dollars. And the reality is it's because they've been paid for the past 20 years to not do it. It's so difficult to do.
Yeah. The one place where I would say it does look to me like there has been a little bit of people hedging back into local, which is why the dollar has continued to be pretty weak. But they haven't given up on their U.S. stocks, and it doesn't appear they may be flattened out on their U.S. bonds that's why yields are not falling again.
Right.
But it does definitely appear like they're, they have certainly not kind of run for the exits as of
Yeah.
yet. And we wouldn't expect them to, right? It's going to be gradual.
Right. And because every time over the last 20 years, if you've had a 6 month or a 3 month decline, it hasn't paid to do it. But I dubbed this guy the smartest sell side FX trader in London. Super nice guy, and he would never call himself that, but I called him that. And he explained to me that he said, "Oh, what's going to happen, Kevin, is that we're going to get this situation where all these quants are going to run their regression analysis, and they're going to look at this. They're going to look at the correlation between all these assets. They're going to realize over the last 6 months that things have changed dramatically. And they're going to come and they're going to sell their U.S. assets. And to your point, maybe they buy less U.S. assets. Maybe they sell more currency. But he says, come September, there's going to be a lot of selling of U.S. assets and U.S. dollars." And I said, but wait, they can run their analysis. You just told me it's on the first half year. And he says, "Oh no, you foolish North American. You don't realize nobody's going to do anything in the summer." And so he's very much in your camp of this huge selling. I guess what my question to be is, like, as I'm thinking about this, we've subsequently had a rally back up. Is that enough to make everyone say, "Oh, you know what? It wasn't that big deal. It was a one-time affair," and reason through it? And like, what would be your pushback to somebody who says that, anybody that is going to adjust their portfolio from this is just a panicking?
Yeah. Well, look, recent history would tell you ignore these shocks and you kind of soldier through. And I think the natural state of any portfolio manager is to prefer not to do anything, right?
Oh.
Because it takes time to, you got to push it through particularly for these larger institutions. Yeah. You got to write it up. You got to push it through the investment committee. You got to socialize this with, you got to run it through the consultants. You got to do. And so there's an inherent inertia to people not doing it. The other thing that, comes with this, and I've thought about this from an inflation standpoint and others, is that when you make the intellectual leap that all of a sudden a significant portion of your portfolio is misallocated, that makes you have to do a lot of things. So there are secondary and tertiary effects with saying, hey, we're just long too many dollar assets, or we don't have enough inflation protection. When 80 or 90% of your underlying portfolio is effectively short inflation, short volatility, that creates an environment where you're like, think about all the things that I have to do if I really embrace that, evolution of the paradigm.
Okay. Could you explain to us what you mean by that? Like that their portfolio is short inflation, short volatility?
Yeah. I think if you look at, and again, I'm making a huge generalization.
Yeah. Understood.
But people who are, long U.S. equities are, when you've got such an incredible tilt on growth versus value, you've got very high PEs under the assumption of very high margins, and you are, long some significant component of U.S. bonds, and you look at things, allocations to places like private equity and venture, which are effectively, that's equity and drag. It's long equity, either with a leverage component to it or an early growth high multiple component to it. So, when that and I think to some degree you look at all of these pod shops, and a component of what the returns that they generate is predicated on how cheaply they can borrow money, correct? Because when you're using 6 to 8 turns of leverage, that cost of capital is very high. So even that model is effectively kind of short inflation. So it's a bigger question than kind of thinking about the dollar implications of it. If the world says, okay, I have to bias my portfolio to be a little bit more pro-inflation, it basically, people then take a look and say, well, shoot, 90% of what I own is kind of anti-inflation and short volatility, because higher volatility regimes give you lower PEs. They don't give you the kind of big equity windows where you can monetize from either private equity or from venture. And so, all of those things are like, look, we've been in a posturing that has been spectacularly successful for the last 20 plus years. If this is really a change that we have to consider, we have to do a lot differently. And that's a lot of work for people who are, trying to, manage trillions and trillions of dollars of portfolios.
Where do you think we are in terms of them coming to realization that inflation is actually higher than they accept, and that volatility going forward, it might be higher than they expect?
I still think there's a lot of people who want to write off 2022, which I thought that, look, there's some great longer term relationships that if you look at something like the S&P versus the CRB, and you look at that over, 80, 90 years, you see these big, and they are longer and more powerful periods of time where stocks outperform commodities. And it runs for 13, 15, 17 years. And then you get these very clear periods where commodities outperform. It's for shorter, and you definitely don't make back up what you lost in the up equity cycle. But, it's 7 or 8, 9 years where commodities outperform. And it looked like that relationship kind of peaked out in 2021. And we were turning onto one of these 7, 8, 9-year cycles where commodities were going to rule. And we rolled over 2022, finally energy outperformed for the first time in like a decade. And yet this AI bubble and, return to crypto and I think, easier money status and the advent of, highly levered vehicles like levered ETFs and zero DTE options and things like that gave you it's like they were like the shocks to the heart of this equity and risk asset outperformance that kind of boom popped it up to a new high.
Okay.
But if gravity, financial gravity, starts to take effect, which I think we're in the zone by which we can possibly see that, then we've got a 6 to 10 year period where I think commodities outperform. I think the broader markets are still vastly ill positioned for that. And I think it will take a period of time where raw materials, inflation sensitive assets will need to put up another period like 2022 and maybe even a little bit longer for people to say, okay, this is less than a blip, it's a real trend. And so I think it's going to take some time. But the fact of the matter is, once that happens, it's a whole lot of money moving into a sector that doesn't have a whole lot of market cap anymore.
Yeah.
S&P Energy's gone from 15% to sub 3.
Yeah. It's fascinating. And I think that people forget and just kind of have become numb to how large like those Mag 7s are and how much money is in there. And even if you just a little bit starts to go chase these things, and like, I'm a big believer in gold, I think as is you. And I've always, subscribed to the Grant Williams theory that all you need is just at the margin, some big pension funds saying, I want to just invest a little bit more into gold, and the thing goes to the roof.
Yeah. Well, and the real driver on flows is that, look, if people want to invest money in tech, we've just seen, a couple of IPOs that have given you, $50 billion worth of additional tech, market cap to be able to buy, right?
Right.
The vast majority of resource companies are actually slowly taking themselves private. So they are decreasing their flows. If you look at, our mutual friend Vincent, who introduced us.
Yeah.
Vincent Deluard had a spectacular chart a few months ago when he was talking about the energy space, which was the total shareholder return, which is a combination of share buybacks and dividends. And the energy sector right now, just to take a subcomponent, is at 8% total return, dividends and share buybacks, which is like 3 times any other sector. And if you look back over the last 20 years, it's the highest reading of any sector that you get outside of the GFC and COVID.
Wow.
These stocks are being treated like we're in the middle of a crisis, while the rest of the market is, party on Wayne, party on Garth.
Right. And what do you attribute that to? Like, why don't they get any more love? And like, I would love your thoughts about that.
Well, I think this applies across a lot of different resource industries. So if you look at the history of the last 25 years, there was a huge institutional push into the Goldman Sachs Commodity Index back in the 2003 to 2007 timeframe. So you had what went from kind of a zero market to everybody like, hey, we can just ride this roll yield with the proper forward curve. And so you got a huge, $1/3 of $1 trillion allocation that then got totally smoked in 2008.
Okay.
So then you had the shale boom that popped up in kind of 2010 to 2020, where again, you sucked in 300, 400, $500 billion worth of capital of institutional clients to a place where there was a big theme going on. And by the time all of that kind of private equity and credit and everything else got marked to market at the end of 2020, you hadn't made any money on that. There were outliers within it. So some funds did really well. A lot of funds did really poorly. A lot of them were marked with kind of what we call the gentleman's 1.2 times, where a lot of these private assets sort of get a courtesy mark until markets force you to do something different.
Right.
But effectively, that was another kind of $1/3 to $500 billion that spent a decade going nowhere in a market where broader returns were very good.
Okay.
And so the institutions are like, look, we've been, for lack of a better term, screwed by the resource sector twice. You layer in a decarbonization ESG mandate where you had investment committees who are like, I don't care if these things are useful. You just have to own less of them.
Right.
Because this is part of the BlackRock ESG. We're not going to support if you're a extractive industry company, you can't even get insurance. Or for a bank, we're going to stop loaning to. The Australian banks got out of the business of loaning to resource companies, as did a lot of the European banks. So it's been one of the most extraordinary decapitalization stories in the history of any sector that I can imagine. Tobacco being similar. I mean, but the good news is they don't need banks. They're self-funding themselves now. And it's actually a much better capital allocation backdrop where this forced underinvestment is setting up what makes for a very interesting supply-demand balance for the next decade, because the stuff that you needed to do to give you a copper mine in 3 to 5 years or an oil production facility, in the next couple of years, you had to do that 5 to 10 years ago.
Right.
And we haven't.
So, Robert, if I get it right, we basically have this environment where we haven't invested in what's needed to produce these commodities because we had such an overinvestment and such a boom in the 2000 to 2010 period. Is that correct?
Yeah, and really it sort of was a byproduct of the commodity boom in 2002 to 2007 that kind of echo boomed into 2010, where you had these massive capital investments that were a reaction to a growing China and a massive resource intensivity that came with it. So we built a ton of capacity. A lot of that was misallocated amongst companies. They made expensive acquisitions. They bought stuff too expensively. And then the byproduct of that is we've sort of run off all of the easy incremental production. We haven't invested significantly over the last decade or so. If you really look and you look at the biggest resource companies around the world, sort of global investment in publicly traded companies in resource assets went from like $600 billion, give or take annually, back in 2015 to now it's running more like 200 billion. So maybe 250. But so you're talking about a nominal decline of well over 50%, and inflation adjusted decline of more like 70%. And so, you just can't fill the pipeline if you're not spending the dollars.
Okay, so it's set up this great environment going forward. So far, the market hasn't cared. I'd love kind of just now, let's get a little bit more into the nitty gritty of how you take advantage of this macro environment that you see unfolding, which is a positive for resources. Like, how do you play it?
Yeah. So for a lot of my early years as a resource investor, I was very interested in kind of finding the value creation earlier in the investment cycle. So exploration stage and early development stage companies where, how do you express your cheapest barrel of oil or a pound of copper or ounce of gold in the ground? The 2010s, sort of beat that impulse out of me. And the postmortem of 2008, where I thought I owned a lot of cheap stocks, and yet they still went down 50% or more, was that there's a very short list of companies that sort of can take advantage of those sorts of cycles. And I looked at 500 or 600 resource equities, and there were 6 that were up in 2008, and they all had very similar characteristics. They were low-cost producers, generated a huge amount of free cash flow, didn't need money from anybody, and could take advantage of the downturns by buying back their own stock on the cheap, buying back their own debt at a discount, or buying out some assets from their competitors who got too far over their skis and then had to liquidate in the trough. And so the idea of what we run, which is called the Real Assets Equity Income Fund, to buy these free cash generating companies where, look, they may not be the best performing stocks in the upcycle,
Right.
but they protect capital way better in the down cycle. And so what I call the general term that I put to this is positive carry convexity. So if I can find companies across the resource spectrum where I'm getting paid 5, 6, 7, 10, 12% dividend yields from sustainable assets, it's important to know that those yields are sustainable, even in a fluctuating commodity price environment. And I buy those at historically very cheap valuation multiples, which is where the convexity comes from, where at some point, if there's a re-rate in this kind of stuff, that you get this, high single digit to low double digit income generation every year that kind of pays you to wait. And then at whatever point that people actually start to care,
Right.
you get a multiple uplift on top of that. So if anything, you can kind of term it as a real world tip,
Okay.
except you're getting paid a hell of a lot better than a tip. And you don't have to trust the government as to what the inflation is.
Right. That's a terrific way of looking at it. Not only that, correct me if I'm wrong, but like one of the things that I've always argued when folks get bullish on, like, let's just say uranium, and they start telling me about some little crappy uranium company, and I always say, listen, if it's a true bull market, the Fidelities of the world, they're not going to buy your crappy little stock. They're going to buy Cameco. Yeah. And so in fact, at least for a while, until the very end, doesn't that kind of the big lower cost producer do better?
The big money typically starts with the big established producers. If you want to extrapolate that to the gold space, it's with the Agnicos.
Right.
So it wasn't Newmont, wasn't Barrick, but it was the good companies just under below that tier where the Alamoses and Agnicos were the ones that really outperformed. And so that's kind of the sweet spot for the early stages of the cycle. As you move later, you want to move a little bit further down the risk curve. But yes, I agree with that. The early stages, you are always paid to go where the bigger institutional dollars can get filled.
And so, we talk about commodities as a general, encompassing everything, but in reality, there's all sorts of different cycles. And I've heard you kind of talk about where we are in different cycles. Why don't we just go through some of them and you tell us where you think we are in that cycle? And let's just start with gold, for example, because gold to me feels like it's more along this cycle than, I don't know, let's say copper. And maybe I'm wrong. Yeah. And I would love to hear your thoughts on that.
Yeah. So I'm going to differentiate this. One way is that there's where the commodity is and where the stocks are relative to the commodity.
Okay.
So, and sometimes that can be very different. So for the better part of the last 2 years, I've been talking a lot about precious metals and recommending some of the gold mining companies because the underlying commodity and fundamentals had moved. Not only was the gold price going up, but the oil price was flat to down. And so the underlying economics of the companies were doing fabulously well. Well, up until, January, February of this year, the stocks were still going down. Yeah. So that felt to me like it was a hard pitch. It felt like you got hit by a couple of the pitches, but ultimately when it started to work, it was fantastic. Right. Okay. And so I think we've started that process, but if I'm putting on my kind of macro, hat and saying, okay, where are we in this gold cycle? I think the fundamentals that drive gold are still very much intact. The fact of the matter is people have tried to make, why you own gold way too complicated. It's it's an inflation play. It's a deflation play. It's a real interest rate play. It's a, system is going to bankrupt itself play. It's just a really good portfolio asset for people to use either all by itself or to offset US dollar risk. If you look at the last 5 major drawdowns in the 60-40 portfolio, gold has gone down half as much and recovered in about 1/5 the time.
Right.
So I think that's what central banks are looking at. And it just took a really long time for the rest of investors to kind of catch on, because for the better part of 2023, 2024, it was central banks buying and Western investors kind of ceding that to them and selling to them. But even where we are today, look, gold equities have been best performers year to date. They're still up close to 50%. You can't find anybody to buy an incremental share of the GDX or the GDXJ ETFs. Their share counts have been going straight down all year. That is an incredible anomaly. I've looked at 20 years worth of ETF flows, and there are a grand total of, I think, 6 occurrences out of 120 possible, several hundred possible observations where top performing ETFs have actually had share liquidations through the year. And it's almost always resources. So it's like natural gas stocks, a few years ago. So if you look at, UBS Family Office Survey, 1% allocation to gold. You look at the top 350 hedge funds, their top 20 holdings, so 6,000 observations, there are like 20 funds who have a single gold stock in their top 20. Wow. So it's a cool story, but we have not seen any multiple expansion. And I think this protecting yourself from global, debasement is a pretty big story. And where you've had other big stories like AI infrastructure or European defense, you look at a GE Vernova, where the multiple on that has gone up 3x. You look at a Leonardo as a European defense, multiple has gone up 5x. That was a 5 times earnings company 2 years ago. It's 25 times now. Yeah. Over the course of the last 2 years, even through today, gold stock multiples have contracted by 35%. Wow. So the market's telling you that they're not really there yet. So I think gold itself, I think we're, kind of middle innings. Gold stocks still feel like kind of the, top of the second, bottom of the third. And so I think we're still relatively early there.
Okay. So let's go through some other ones. And I guess to some extent, gold almost feels like something different because of that debasement theory, and like it's as you mentioned, something good for the portfolio. Let's do copper next, since I mentioned that. Mm-hmm. Where do we stand with that?
So copper feels to me like there were a lot of people who piggybacked off of the AI theme and said, all right, I own all of the big hyperscalers. I own the companies that provide a lot of the infrastructure. Where can I go next? And they own some copper companies and some natural gas companies, not with high conviction or firm hands, but it was more like, okay. And so that it moved up valuations in both copper stocks and natural gas stocks. We were actually kind of tactically short both, thinking that we might get some sort of sell-off relatively recently. We're kind of flattish on both right now. But those are in places where I think the stories are very good. The good story for copper out 3 to 5 years, great. Natural gas as well. The problem is we're going through this kind of middle zone where you're really kind of economic activity reliant. And if you don't have a particularly bullish opinion about where the kind of physical economy is going, you're probably in for some turbulence. They're not rock bottom valuations. The stocks aren't kicking along at 52-week lows. So in fact, a lot of the headline natural gas stocks are a lot closer to 52-week highs. So I think there's some kind of price vulnerability there. So I think they're good long-term stories. I struggle to find kind of the near-term value if you're sort of sub-year looking at.
So let me just get it straight. Although you're an inflation bull, you are an economic bear. Is that correct? Or at least for the short run?
I think I'm an economic bear relative to what the broader stock market seems to be discounting. Look, there's enough good stuff going on in the economy. And I'd love, again, our friend Vincent, looking at real-time tax receipts, that's telling you that there's some underlying strength. But man, you look at housing starts or credit card defaults or, what some of these, drilling down to the consumer credit level, bankruptcy filings and all the sorts of things. There's enough noise in there that I think I'm just I'm balanced. I'm meh on the economy. And so I can't get super bullish on it.
Okay. And you mentioned, do you view copper and natural gas as the two most economic sensitive of the resources?
Copper, definitely.
Okay.
And there's been a lot of noise there because of the potential tariffs and the arbitrage between U.S. prices and global prices, and so I think it's going to take a while for that to shake out a little bit. Natural gas has more supply demand dynamics than are just economically driven, but they've now got a very AI growth of tech overlay to them. If you look at how the natural gas equities are valued.
Oh, not the commodity itself. Like none of these guys are going and buying the commodity because first of all, it carries terribly and stuff like that. But so you're saying that they piled into the equities.
Yeah, to the top 5, kind of natural gas equities, and so I think that was the case. And I think they owned the Freeports and Antofagastas of the world as well. And I think we saw some of that come out here in the last week or so.
Got it. Okay, so that's almost like the AI boom has dragged up some resource names, and you're a little wary of those.
Yeah, particularly because I think the hands that own them, even though they're the cheapest stocks by far in the AI related portfolios, I don't think they're high conviction hands. And if things start to wobble there, then that's going to be the first place that they chuck ballast.
Yeah, they're not going to sell their NVIDIA. They're going to sell their Freeport.
Yeah.
Got it. Okay, that's great. I love that. Well, let's go through. You've mentioned energy a few times in terms of oil. Yeah. I would love to hear your views there and where you see the opportunities.
I kind of love the bearish sentiment in oil. Like colleagues of mine through the years and people that I hang out with at conferences, they're like, "Why do you always go into the empty rooms?" No, I'm just an empty room guy. I love kind of despair as an investment backdrop. And it feels like the closest place that you find despair in these markets is traditional energy. Even though you look at the marginal frac spreads, and I've got 5 cousins who are operating in the oil patch in the Permian Basin, and they're like, man, no one's picking up their phones anymore. And so, the U.S. has accounted for over 100% of the incremental oil production growth over the last 10 years, and we're flat now. And people are pointing to Brazil and they're pointing to Guyana and a few other places. And it's like, that's going to help a little bit, but there are a lot of other places where it's falling off. So I have become much more bullish in energy. I've probably taken a little bit of kind of gold chips off the table and started to move them into the traditional energy base. And I think the best way in my framework where I'm finding to express that is some of the European oil and gas companies, upstream producers in the North Sea, where you can buy stuff at 10+% dividend yields. These companies are trading at 1.5 or 2 times cash flow, and just incredible bearishness about the regulatory environment and the tax regime. At the same time that the U.S. administration is sending a very clear message to everybody around the world. It's like, look, everyone, take off your training wheels, put on your big boy pants. You all got to take care of yourself. And the backdrop for European energy, it's the most catastrophic own goal in the history of mankind, right? These guys had a great functioning nuclear fleet that they decommissioned to build a bunch of wind and solar. And look, wind and solar in the right place is great, but where you've got the Dunkelflouts and which is the wind not blowing for 30 days in a row, and you're effectively at the same latitude as northern Michigan or Vermont, that's not a super solar spot, right? And so they've made themselves very fragile, and I think they're slowly, having gotten beaten over the head really, really badly, realizing this. I mean, their excess electricity bill in 2022 was bigger than the entire cost of developing U.S. shale.
Wow.
It was $500 billion that for them was not what they paid for energy in that winter of 21 to 22. It was the excess that they paid above what they paid in pre-COVID. So it's just, and so I think from their standpoint, look, you say what you will about the Russians, but they did provide reliable and cheap energy for about 40 years before they ended up screwing Europe. Right. Are you really going to put all your chips in with, we're going to trust LNG coming from the US when this administration has shown that we will use every weapon at our disposal when we choose to be able to cudgel you into doing something else. And so I think there's going to be some people in Brussels who are like, you know what, maybe we should rethink this whole, it's okay to produce molecules in Europe again.
All right.
So that's my
sorry, didn't mean to interrupt. I would love to hear a couple of stories. A couple of names that you might, people might look at.
So a couple that I like in this genre, you can go either with the Norwegians. They're not quite as cheap. They're only, like 2.5 times cash flow, but like VAR Energy, VAR Energy is a company that we own. Again, double-digit dividend, super cheap, can grow. One of the ones that we've recently been adding to is a company called Harbor. Where you've got Harbor Energy, which has been one of these companies that has just aggressively scooped up all of these old fields that the Shells and BPs and Totals have been shedding at rock bottom prices to then invest the money in wind and solar, which, so selling stuff at 1 times cash flow to buy stuff at, that may produce cash flow at some point or may not. So, Harbor's got a lot of very specific catalysts. Their mix is actually going away from Europe. They're getting less UK, more Norway, which is good. They've also got a great set of assets that you just purchased in Argentina, which I think is going to go from kind of 10% of their asset mix to more like 20 or 25 over the next 3 to 5 years. And that's a great place to do business. You're going from like a 90% marginal tax rate in the UK to a 70% marginal tax rate in Norway to a 35% marginal tax rate in Argentina. So your marginal barrel of incremental production is incredibly profitable. So you can grow earnings and cash flow even if you're not growing production. And so, it's great. And if you look at it on kind of an apples to apples basis, Harbor produces 500,000 barrels a day. That's the same amount that Diamondback Energy does. And so, that's big E&P. The difference is the enterprise value of Diamondback is about 60 billion. The enterprise value of Harbor is about 10.
Right.
So
let me just get it straight in terms of getting your kind of big picture view.
Yeah.
The main issue is that shale is actually declining faster than the market realizes.
Yeah, and shale will not grow at $65 to $75 WTI. Right. It just won't. And so if the world is growing at all, again, I don't have a super robust economic outlook, but I think if the world grows at all, you're talking about 750,000 to 1 million barrels a day, even if you use a very conservative multiplier on what you get from GDP, that's a pretty good backdrop. And again, in these particular cases, I'm getting my positive carry with double-digit dividend yields, and I've got my convexity because you can make a lot of money going from 1.5 times cash flow to 2.5 times cash flow.
Yeah.
That's my jam.
Okay. Uranium, I'm going to ask, but I'm assuming it's very much like copper and nat gas, and that you think too many weak hands have rushed in. Am I correct in assuming that?
I think it's less weak hands because I rank my resource zealots on a scale where it's like, okay, your gold zealots are like a 7 out of 10. Your silver zealots are kind of like a 9 out of 10. Your uranium zealots it's like, what is it?
Go to 11?
Spinal Tap. It goes to 11. So the people who love uranium, and look, there's a really, really good case for uranium. And I think it's so painfully logical that this is the direction that the world has to go in. Even if you don't care about carbon intensivity, you would go this direction anyway, because big, reliable baseload power that doesn't have a gigantic footprint. So it works. The problem is, as a value guy, there's one stock in the entire uranium universe that I can own from someone who actually pays attention to a cash flow multiple.
Yeah.
And it's Kazatomprom. And so you're taking on Russia risk. And so
Right.
it's really hard to express. There's a way to do it through, there's actually, one of the groups that does the uranium equity and physical uranium ETFs, which is Sprott Inc.
Yep.
is a holding for us, both because of what they do in the precious metals as well as what they do in uranium. So I think that's to me, the only way that a value person who takes geographic risk and geopolitical risk seriously can kind of express a view there in a way that fits with the way I like to invest.
And just to be clear there, because Sprott actually is also the manager of the uranium closed-end fund. So you're not talking about that. You're talking about Sprott, the management fund itself, that it will be
Correct.
the beneficiary of those assets increasing, right? SII, is that that's the Canadian symbol at least?
Yeah, that's correct. And actually trades that in the U.S. as well. The stock has had a really good run. So it's something that people should be cognizant of, that, the valuation has expanded. That said, I think history has shown us that if there's a unique way to play resource companies without having to embrace typical resource specific risk, geopolitical risk, tailings dams blowing up, that there are times where people have put unusually large multiples on that. You can look back at what they did to what I think was the kind of equivalent of Sprott back in the 2000 to 2007 cycle, which was U.S. global investors. And that stock, in a relatively modest part of that middle part of that gold rally, from 04 to 06, I think, gold was up 25%, gold stocks were up 50 or 60%, and GROW, which was the ticker, was up 1,000%. As investors who didn't like to own the specific companies and just said, hey, if the sector is going to win, find me a way to play it.
Okay, so Eric Sprott is a Canadian, and so far I haven't asked or heard any Canadian names from you. I'd be curious, like, you didn't mention any Canadian oil or energy names. Do you have views there? Are they just too expensive? You're worried about the political risk?
I do have some positions there. So, I've owned Whitecap for a number of years, which, Grant Fagerheim's, been a friend of mine for 20 years. And I think he's a brilliant guy in putting together what is, I think, in my genre of, really good, consistent cash flow generation that he's going to be returning to shareholders. Okay. That's fantastic. But I will say it's not that I dislike North America. And I will say that, I didn't go out trying to make a massive shift away from North America in my portfolio. It was really driven by the individual values that I was finding in the underlying securities. But I'm typically 50 or 60% or even more, kind of US and Canada. Yep. At this point, I'm 25%.
Wow.
Just because the values elsewhere are speaking to me and fitting my mindset in a better way than most of what I see in the US and Canada.
Can I ask what you do about the currency risk? Do you just let it ride?
Yeah, I typically don't hedge it unless I have a very specific view on the underlying currency in those areas. But typically I don't do anything specific to the risk. I do use currency options and currency vol as part of my tail risk in the portfolio, because that's areas where you can get a lot of bang for your buck in terms of convexity in various outcomes that are maybe manifested across the risk spectrum, but can just be expressed most cheaply in the currency markets.
Oh, so you'll trade currencies as well?
Yeah.
I didn't realize that. Okay. You know what? We're getting towards the end here. So one of the things that I like to kind of put to the my guests is, like, I've asked you a lot of questions. If you were interviewing yourself, what do you think I missed? Like, what would you ask yourself that's a big deal right now that I might have overlooked?
Now, look, I think you covered a pretty broad swath of what, I mean, the one area that I've been doing a lot of work in as it relates to broader macro systemic risk is what's been going on in private credit.
Oh, yes, that's right. You send me a chart and then I completely fell down. So it's good thing I asked the question.
Yeah. So look, I think it's really interesting. And look, I consider myself a good balance sheet guy. I'm not a private credit analyst, but if you read everything about what's going on there, we've got an industry that's gone from a $50 billion industry back in 2000 to a $2 trillion industry today. And look, I don't think the vast majority of those loans go bad, but I think the way it's being treated in institutional portfolios is a little disingenuous. It's like, look, the traditional volatility return spectrum that, was the chart that I sent you says that, that an asset that is pretty close to high yield, but is actually should be, more risky than high yield, because these are by definition companies that the banks won't lend to.
Right.
Because if the banks would, or they could access the high yield market, they would at 7, 8, 9%, as opposed to issuing private credit at 13, 14, 15%. And yet the way it's being characterized in institutional portfolios is a sub 4 annualized volatility asset.
Yeah. It's insane.
So again, I don't think the entire sector is going bad, but if half of the companies don't generate free cash flow, as stats that we've seen, if 25% of the companies are covering interest in the form of PIK securities, up from 15% last quarter, there's, look, if it quacks like a duck and walks like a duck and has all the markings of a duck, just because you don't look at it every day and you only look at it every 90 to 180 days, it doesn't make it a swan, right? So I think the risks there are that private credit has grown in such a way that it has been the duct tape and baling wire that has allowed private equity and venture and even commercial real estate to continue to, sustain themselves in an era where the traditional banking sector is not extending them credit. And so what if that, provider of duct tape and baling wire all of a sudden kind of decelerates and it's not there anymore? And that can cause sort of a series of, having to remark things within the portfolio, which means you then have to sell public equities to be able to offset that risk. And so there's just, to me, there's a lot of systemic risks there that, again, it's 2 trillion. So it's not that all of them go bad. It's just a change in trend may be the only thing that is necessary to cause a sequence that in the wrong, broader macro backdrop could get pretty unfortunate really quickly. And I think most portfolios are not well positioned for that. So I think you want to be long volatility. And I think you want to be long volatility in all its forms. And particularly, I think you want to be long anti-correlated volatility, which I think in this broader purge, as we talked about, where people are trying to expunge volatility from every facet of their portfolio, I think it's time to look for useful volatility.
What would you be at the forefront of your examples of useful volatility?
So look, I think gold is serving as that now to broader institutional investors where, look, the last drawdown in gold when we had the tariff tantrum, it recovered its old high in 2 days. Yeah. When you look at drawdowns and recoveries, and that tells you the response function of the marginal buyer is like, okay, big drawdown. We know exactly what the playbook looks like. We're going to get there first. Right. So I think gold is there. If you look at what the vulnerabilities of the broader market are, I think inflation is a significant vulnerability there. And we've got, all the papers, commodities for the long run, et cetera, that is a substantially, that commodities themselves are anti-correlated. If that is a vulnerability do you want to hedge yourself against, and commodity equities, when they're trading at the lowest relative multiple in 110 years, according to the guys at GMO who do wonderful work there, that can be a very convex way to hedge out. And look, I'm talking my own book left to right, but I do genuinely feel like the broader market is blissfully unaware of the risks that they're facing right now and very complacent in terms of the way that they're allocating their assets. And it doesn't take a lot in a strongly anti-correlated asset to make a big difference to overall returns.
That's some terrific stuff. Now, before we leave, I got a couple of questions I'm going to ask you. That's going to be a little bit of fun. But first, you live in San Francisco, and you were telling me a stat before the show that I would love for you to share, because I don't think that, well, maybe everyone knows, and I'm the biggest idiot out there, but your area is the most Democratic area in the U.S.
I live a block and a half from the corner of Haight and Ashbury Streets in San Francisco. And my zip code is, think it showed up as the single most Democratic zip code in America. I think it's somewhere between 93 and 94%.
I was just blown away by that and think it's so funny. I guess all the deadheads and everything like that, they're still there, and it's great.
It is. As I said, it's not a place you want to pull up in your Ford F-150 with a drill baby drill bumper sticker.
I know. I think the irony of the resource hedge fund manager living there is just awesome.
I don't discuss what I do with my neighbors.
It's your dirty little secret.
Yep, exactly.
Okay, so we're going to end with this one last question, which is, it's going to be the Desert Island Trader Edition. You're going to be put on a desert island, and you're going to get 3 albums or bands. I don't care. Wait, just tell me what your 3 albums or bands you're going to listen to, and then 1 trader. That's the only person you're going to be able to talk to. And this trader is a guy from or girl from any time, any era. Like you can get Jesse Livermore in the 20s, whatever. Mm-hmm. The only rule is you can't repeat what's already chosen. And so far, Ed Thorpe has been chosen. Otherwise, it's a wide open swath for you. Let's start with the 3 albums.
So the 3 albums, I would do Pink Floyd, The Wall.
Okay.
I'm going to harken back to my college days, and I'm going to do the Dave Matthews live album from because it just recalls such a wonderful period of time in my life. And then, if I'm just chilling out on a desert island, I think, bring me a little Mumford and Sons.
Oh, there we go. Okay. Yeah. All right. And then your trader that you're going to get to, chat with markets about.
Yeah. Well, I think in terms of traders who I think would continue to be really effective over the next 20 years. Look, I've read every Market Wizards book there is, and God, there are a lot of people who've done some remarkable things. I take Druckenmiller 6 days a week and twice on Sunday. I think as a person who genuinely understands the evolution of how markets, what it cares about and how to generate the kind of risk-adjusted returns that dude does. I can't go any other direction.
I'm with you. The guy he's just every single time, like you'll hear an interview and you'll be like, well, I own whatever. And you'll think, oh, why is he on those names? And then you spend the next, 6 months sitting here and you go back and you look and you're like, oh, geez, those were the best performing tech stocks, or those were the best performing this. The only thing you have to do with him is you have to put aside his political things every now and then. But I don't think he trades those. I think he actually just says those and doesn't trade those.
No, he's incredibly pragmatic in the way he runs portfolios, and he lets the market speak to them. And I think ultimately, for a guy who's been so incredibly successful, that he must have almost no ego, because he's not afraid to say, all right, hey, wrong about this. Move on. And I think that's such an extraordinary skill. And I used to be really, really bad at that. I think I've gotten less bad at it. But that's what makes a truly amazing trader. So.
I love it. All right, Robert, before we let you go, why don't you tell us a little bit more about your shop, where people can reach out to learn more about you and what your firm does?
Yeah. So look, I run a fund for private investors. And so you need to be accredited or otherwise, sort of reach a high net worth minimum. You can find out a little bit about us at mrafunds.com. Marathon Resource Advisors is the name of the firm. I'm an occasional poster on X at mrafunds, plural.com, or sorry, not .com, but just at MRA Funds. And so, we're a relatively small shop and like to talk about the things that we feel strongly about. And so if anyone's interested, they can reach out to me through either one of those mediums.
That's terrific, Robert. It's a real pleasure getting to know you. And I just want to thank Vincent for putting us in touch, because it really, truly was a terrific interview, and I really enjoyed it.
Vincent's the best. He's, great part of the San Francisco investment community.
Oh, yeah. I forgot. That's how you guys must know each other, right?
Yeah, he's out here. Oh, God. We used to have a great hiking group up in the foothills of a bunch of macro guys during COVID, and he was the one who invited me into it. So.
Oh, that's terrific. Oh, well, thanks again, Vincent, and thank you, Robert. All right, Patrick. We finally got at least a little bit of a correction, right?
Yeah.
So tell us what you got. We're in Talking Charts, and Patrick's going to lead us on our adventure.
Okay. So the first thing that I want to highlight was that going back a couple months ago, originally I felt that there was a very good chance that the market was going to find some heavy resistance at its previous highs. And the market ripped through that like a hot knife through butter and proceeded to move higher, which then we have to go to techniques that we use at Big Picture, like of measured moves. And so the different measured moves were all targeting up to the 64 to 6,600. And there was definitely room for the S&P to finish in advance up there. And it really felt like it, like when Microsoft beat and Meta beat and the S&P gapped higher, typically that is the kind of like adrenaline hit the market needs to create that positive feedback loop of another wave of buying. And so the fact that the market sold on the positive news is a characteristic, a market characteristic that tends to happen when a market is transitioning into a distribution cycle. So I like instantly shorted when we got in the red yesterday, just because it was so wrong that the market couldn't hold its gains after such positive news. And so the market was already in some sort of a correction even before we got these jobs numbers. And the jobs numbers was just like fuel to the fire, like fuel on the fire. Like we basically had a jobs numbers that came in at 73K, the non-farm employment change. And it's the weakest number we had since that really bad miss in November. During that period. But generally, jobs have been trending down.
Yeah.
And this
not only
is
that, Patrick, sorry to interrupt, but another big thing that the market is grappling with today is the fact that the revisions for last month were terrible. Let me just grab you the number, because I believe it almost erased all of the previous jobs that had been good. Yeah, here, let's look at it. Prior was 147. So go back to your chart.
Yeah.
So just pull that up. No, the chart. No, sorry, your chart. There it is. Yeah. Okay, so that last 147 there, that bar is really 14.
14.
Oh, yeah.
So, the one thing I talked about in the last episode and the other and previous ones was, are we witnessing Fed policy error? Like, are they keeping too tight? Especially when so many global central banks have been cutting, and they keep worrying about this inflation number, then inflation that just isn't materializing.
Well,
and even
okay, sorry, I'll let you finish.
No. All I'm saying is that Trump is obviously using his personality to kind of try to bully the Fed into easing or making it very clear that he is not aligned with the Fed's approach. But historically, the Fed tends to be late and then reactive.
Yep.
And what if this is the market realizing that this is really starting to manifest that way?
So I'm not going to disagree with you there. I will only push back a little bit in that everyone is talking about inflation isn't a problem, but I'm pulling up the PCE core inflation, which is what the Federal Reserve uses as their inflation gauge that they're targeting. And it's still 2.8%. We have not got back to target. Well, so yes, I hear you, but and up until now, we haven't had any real payroll weakness. You could argue that at the edge that we were, that it was softening, but given that inflation is still not at or below target, you shouldn't expect the Fed to be doing anything different.
So right? Look here, month over month. Look at this chart, month over month. Right. Overall, it's not like we're seeing true outlier spikes that are overly concerning. Now, yes, is it the same as it was back in 2018 and 19, where it was steadily in the 0.1, 0.2 range? No, but I mean, this is not exactly crazy numbers that we're
I know
seeing.
you're looking at the month over month ones. That's difficult. And I
But the
hear
month
you.
over month is the accumulation
I
of
get it.
how you're getting to your 2.8.
I'm just saying, like, listen, I don't want this to be about politics, and everyone's gonna, shit all over me for this next comment. But if Kamala Harris was the president, then I very much doubt that Stephen Moran and Scott Bessent would be pushing for rates to be significantly lower. In fact, I think that they would argue that that the PCE core inflation is still not hit target and that they should be higher, and the Fed risk losing credibility by not achieving their target. My point,
I don't.
Oh, I completely agree. I think it's just
you completely agree that I disagree.
No, I completely agree that's what. Sorry, I shouldn't say. I completely disagree with you. That I think that's everyone is seen through the lens that they want to see it through. That they're, if they're this way, if they lean this way, then they expect this. And I think the Fed is rightfully just on hold until it becomes clear which way it goes. And to your point, they're gonna be late. It's a story as old as time.
Thank you. So I will be right. In the end, they're keeping things too tight, too long. Something is going to break. There's going to be a gear, like a wrench thrown into the gears of the plumbing. Something that we're not talking about today suddenly is going to emerge, and the market dynamic is going to pivot faster than you can blink. And so the question, and let's just go back to the charts then. The question is there something ominous underway here? Now,
one second. Can I before you go on to that, I want to quote a guy that you probably like a lot. He came up with a little formula about inflation, Milton Friedman.
Okay.
He said the following.
Cool guy.
Cool guy. The Fed only knows two speeds: too fast and too slow.
Okay.
And I think it's just it's as I said, this is just how it always is. And so maybe you should be arguing that the Fed should be getting ahead of this and cutting rates. But what happens if the Fed cut rates let's say they cut rates 3 months ago, and then inflation started spiking up? Then they're forced to go chase it the other way.
Where is the feed mechanism? Okay, like I want to talk charts, but as far as I'm concerned, the predominant spending, and this you've been talking about, predominant spending in the economy is through these huge fiscal spends by the government. And
wait, is the monetarist gonna adopt fiscal policy?
What I want to highlight is there has not been a hot consumer that needed to be cooled off by high interest rates. There hasn't been a huge credit expansion, and private money center banks have been printing like nobody's business. The fact is that keeping conditions tight, it's not like if they eased a 1% that suddenly consumers would be rushing off and all the huge loan creation is about to go rampant. The fact is, I don't think that these tight interest rates are going to have any dramatic impact on inflation, because I don't think that the consumer is going to go and lever up, and credit creation is going to go wild if they cut an extra 100 basis points.
So I think this is hilarious because you're the monetarist. You're the one that would be usually arguing this. So I tend to agree with you. I actually think that interest rates are way less powerful than anyone expects, and that this is a lot of moot points because really fiscal is driving the economy way more. Yeah. I just think it's just kind of funny.
I actually just learned that from you. So you're Captain Fiscal.
That sounds really wise. I'm just going to leave it at that. You're really smart guy.
Let's talk charts.
Okay.
All right. So now the one thing I'm positive everyone wants to know is this the big scary drop? Is this the beginning of something ominous?
No. One second. what everyone wants to know, does Barry Manilow know that you took his shirt from his wardrobe?
Go vintage, baby.
Pretty great shirt, by the way. For the folks that aren't putting this on TV, tune in.
1970s vintage.
To see Patrick's shirt. It's awesome.
I got it from my grandpa. No,
did you really?
No.
Okay. Anyways, I'm sorry to interrupt once again.
So the question, okay, the second most important question after the shirt is whether or not this is something more ominous. Now, look, there are a few times, where markets will V-top, right? Like COVID was an example, or the Volmageddon event, or these other events. The market just reversed on a dime and crashed. So these kind of things happen. But it is not the common way that markets transition at tops. More often than not, they go through a distribution cycle. Think of the best analogy is literally of what happened from November to February, where after the market reached its high back, let's call this the kind of key high. The market still spent 2-3 months kind of trading sideways in a distribution cycle before the real bear market kind of decline kicked in. This happens far more often than a sharp V top. And so just based on history, you have to give a higher probability to the fact that this will find support somewhere down here in the next week and probably retest its highs, doing classic technical patterns like double tops, head and shoulders patterns, other types of consolidations, and then maybe September, maybe the Fed cutting in September will be a sell on news event. And maybe the real kind of aggressive selling happens a month or two from now. Now, it's interesting, nonetheless, I think that there's you have to give it better odds than not that the first sell-off here gets bought on dip. But that doesn't mean that there's going to be new highs. It's just going to be bought on dip, rally back to the highs, and create a classic topping formation. We probably have seen the high of the third quarter, maybe a chunk of the fourth quarter. There's always a chance a Christmas rally at the end of the year breaks to new highs, but odds are for the next 3-4 months that this is going to mark where the highs of the market are going to be. And now it's just going to be about how deep and how far a market correction would go. I don't want to even contemplate the crash scenarios at this point. I think the support, classic 5 to 5+% market correction, is a direct retest of this 50-day moving average. We already were 3.5% off of the highs. So I'll be watching what the market does here around this kind of 6,200 level on the S&P. And I think that that's going to be a really interesting place to watch. What's your thinking on that?
Nothing. It sounds really wise. Again, you're just full of wisdom these days. What's that line? Something about like bottoms are events and tops are a process. Isn't that
something like that?
Technicians say something like that.
It's paraphrased like that for sure.
Yeah.
And if you think about it, fine, the jobs numbers is a number, but I don't think that suddenly the investor herd appetite can turn on a dime just based on a jobs number revision. I think something bigger has to happen in the plumbing in order for everyone to pivot. Point though, there's a very good odds the tops of the market are in, but if you're buying 30-day put options expecting there to be a drop down to like 5,500, I'd make that an outlier. Like, maybe, like one of those 1 in 6 odds of something like that happening. I think
it's probably even less than that.
Probably even less than that.
Yeah.
The point being that expecting it to initially be bought on dip around the 5% is probably the safest kind of anticipation on it. What I did want to move on is because I've become a stir trader recently, as you recognize. Yes. And so we have to talk about what happened on this jobs revision, because what we basically had yesterday when the core PC and the FOMC were out, we had the odds of a September rate cut actually pivot, where it was 60% that they weren't going to move, and a 40% chance that they were. So when September all year was that moment where they were pricing in the first cut, the moment that jobs number came out, it jumped to 80%, 81%. Like literally now it's on the table for that first rate cut to happen in September because of this jobs revision, and that caused those SOFR futures to have quite the rip. And so we'll start first here with the 2025s, just looking at what they were anticipating for the remainder of this year. I mean, we were down to 4%, the 96 level, and just like that, one entire rate cut was priced in from 96 to 96 and a quarter instantaneously in one day. Insane move, like literally wiped out an entire months of movement. But what's interesting is when you go and look at the 2026 December, which is pricing in, let's call it 18 months. It's probably less than that now, but a decisive breakout attempt. And while I don't want to say interest rates follow too much technical analysis, but this is definitely a consolidation triangle pattern. And the question here, did this spur a new cycle where they're going to start pricing in an extra 50 or 100 basis points of cuts into the market because of this trend next year? That's definitely going to be the puzzle to solve. I think the asymmetry is completely skewed in the favor of playing the upside here, because at this moment, the Fed pulling out any of these priced in rate cuts is small, and therefore the risk of carrying this is, I think, a relatively stable bet. And at the same time, if things keep getting worse, this could have an extra 100 basis points on the upside and get up to even. I don't necessarily want to say it with high confidence that we get to 98, but it's not out of the realm of possibility for a 2% being priced in at some point if things got bad enough. What's your thoughts?
Well, I just like the fact that you become a stir trader, because, after I hang around a lot of different groups, I'm lucky.
You did this. You're
I know. I hang around a lot of different groups. I'm lucky enough to be included in a lot of different chats. And I must say that the stir guys are the biggest bunch of degens that I've ever met. And they'll probably, openly admit this, that they are a different breed. Let's just say the stir traders. And, you fit in perfect. So we just got to get you stop talking about the percentage odds of the Fed cutting or not cutting. I know you're doing that for for everyone to understand, but they would just talk rates and prices, but you're getting there, and you'll be a full degen before long.
Oh, well, thank you.
Yeah.
Thank you. I appreciate
and I'm with you. Listen, I've been, I've hated during 2023 and 2024, there was all sorts of folks that were talking about the economy rolling over, and they were making some bets on the, return to abnormally low interest rates. There was one famous, FinTwit star that reportedly was buying $1, calls, 99 calls on SOFR futures, and because he was so adamant that was going to happen. And I kept saying, no, the economy is better than folks expect. They're underestimating fiscal. They're way too bearish. And now, in this current environment, I've been saying this for a while. I'm on the economy is weaker than everyone expects. And it's like, I'm getting lectured about fiscal, and it's not like I don't understand fiscal, but I think it's already in the price. And there's a lot of other problems that were, very late in this cycle. There's all sorts of, policy uncertainty. And to me, it's just the cycle. We're always going to get, ups and downs in terms of the economy. We're due for one. So I think it's great that you're betting this way. And, welcome to the party, pal.
All right. Well, before all the listeners shut this off because of boredom of interest rates, let's kind of get off topic. One thing though I want to highlight is that the 30-year yield did a pretty big technical move with this breakdown. That 5% was a huge stress point. 5.10 level was a stress point where everyone was watching whether the long bond was going to break. But the fact that we went and retested the highs and are breaking down this way, now it doesn't make me bullish on the bonds, but it certainly has diminished the probability that bonds are going to break in this window, in this time frame. And maybe if we do see a weakening economy, maybe that's not the environment where the bonds will break, and it's going to be more of a 2026 story later on, when things reheat up, one way or another. Just a technical breakdown here. Let's see what plays out. So let's talk about currencies.
Okay.
The dollar looked like the short squeeze was well underway. Right. And it got above its 50-day. Everything was set up for this dollar to go ripping to 103, 104. And that jobs numbers just kicked it in the pants. But I actually love it when something like this happens. It's almost the reciprocal of what happened with the S&P gapping higher on the Microsoft news. When the dollar sells off this quickly, if we find that it holds this 50-day moving average and a retracement here, and then by, let's say, Monday or Tuesday, it's back at the 100 level on the Dixie, then this thing is going to really rip. Now, I'm not forecasting it. I'm saying that this is actually the important, fulcrum point of this, where when you have a one-day sell-off on bad news, the way the market treats the sell-off in the next two trading sessions is going to be a huge reveal. And I'll say, if they get this thing back to 100 by Monday or Tuesday, there's going to be some sort of dollar rip. Now, it needs to do the move. I'm not bullish on the dollar going unless it can actually be bought on dip here.
And this is something you've taught me, and I put into my arsenal as well. And you've said this numerous times in many different securities. It's like, what's important is how the market reacts as it goes back and tests different levels. And so you're just reinforcing the Patrick Ceresna play. And I'm not going to push back.
And this is going to be an important moment. We'll definitely find
And you're
out.
not saying that it's going to go one way or not. You're just saying it's at that point that the truth will come out. I happen to think that the surprises will continue to be on the downside, but you could be right. I didn't even expect it to be
I'll tell you, it will be quite bearish if it breaks down all the way back to it. Like if it wipes out this entire rally, right? And if we get back down below the 50-day and back down here and trading in this range, the downside window is slammed wide open, and this would become a midpoint for a continuation pattern. 95, 94, 93 are all on the table. And it's crazy, but at this moment, you could literally make it as simple as you're bullish if it stays above the 50-day and turn bearish if it goes back below. Like it could be,
there's a true technician. I like
but it literally, but you know what? Like I'll give you an example. If you just remained short the dollar when it broke below in February, below its 50-day, it kept you on the right side of the trend.
I don't disagree.
Whole time.
Yeah.
And so with the fact that the 50-day moving average is right at the retracement zone, makes this a very easy way for anybody to track this. Yeah. And
I'm not disagreeing.
Now, what is also super interesting, I want to talk about gold, but I want to first leave it on the dollar chart here because for gold, literally, like for a while, gold kind of did its own thing. It marched to the beat of its own drum. Sometimes it would react to the dollar or not. But for some reason, in the last 5, 6, 7 trading sessions, it literally has been moving reciprocal to the dollar. Like literally, the low here on the dollar came on July 24th. The high in gold came in on July 23rd. The moment the short-term high came in on the dollar and it pulled back, gold's up $40. Like literally, we're seeing gold in the last few days moving just completely to the opposite of the dollar. And so if we have such a clear indication of what the dollar is doing, what I'm curious about is will this continue? Will we see that if the dollar goes ripping, that we see a gold correction that heads down to 32 or 3100? At the same time, if dollar breaks down or back to its lows, will gold be retesting 3500? I mean, it's curious whether that correlation between the dollar, or inverse correlation of the dollar to gold, actually continues the way it's been going for the last 2 weeks.
Yeah, that's great in terms of, like, that was the thing that broke, post 2022 when Russia invaded Crimea or Ukraine, and now it looks like it's resumed. I happen to think that that's just a matter of the Western flows overwhelming the gold right now, and that ultimately, even if that does go for a week or two, that eventually the longer term demand side from central banks will kick in. Having said that, Patrick, I think that gold, I don't know if you have to be in any rush to buy it. And I really believe gold miners outperform gold for the next little while.
Well, it is interesting because they have been holding their 50-day. They still haven't made lower lows. So overall, they're holding in. But I'll tell you, it's on a nice edge from a technical perspective, because this does qualify as a retest of highs, which could become a double top, but a double top is confirmed on a break of its midpoint neckline kind of thing. And so if for whatever reason something threw a wrench into the gold markets and the GDX closed below 50, suddenly a pullback to $45 to a 50% retracement of the prior advance would be 100% on the table. It's at this moment, in order to keep pressing the GDX story, it's got to be bought on dip here, and it's got to make a fresh new 52-week high above 55. It's got to show accumulation that it's being bulled, that's being accumulated, and that more importantly, it can kind of march the beat of its own drum without correlating specifically to the actual bullion. And so there's a lot in my mind that has to be proven here on that element. I want to move on. Anything you want to mention on gold?
No. I'll just keep going.
I want to touch on crude oil, because crude oil was looking like it was doing just fine. Everything looked like it was rolling up, and obviously this kind of economic downturn scenario, weakening jobs, has taken the wind out of the sails of oil. It'd be very interesting to see whether or not oil can hold the line here during this pullback in a very similar manner to what we just talked about on the dollar. And what's interesting, Kev, from an intermarket perspective, it's probably going to all bounce, or none of it's going to bounce. Like, these things have been so correlated in that manner that the idea that oil will kind of do its own thing, I mean, it would need some sort of exogenous, headline from Middle East or something like this to reprice a risk. Otherwise, if it's just going to have a macro tailwind or headwind, then it's going to probably be in line with risk assets at this point.
All right. What's the next one you got?
You clearly don't agree. Because
I don't. I don't agree. It's just that I've been doing a lot of chatting, and I know you have a lot of charts to do.
But we have to talk about what happened in copper.
And not only that, I was looking forward to this, to be honest. So I take it that copper went to masters to get his master's degree in economics, and then dropped out, and then got back into the program. What is going on?
Okay, smart ass. Listen, okay, let's get something straight.
Yeah.
This was purely a Trump effect.
I know, but it's just I always hated that line.
Okay,
Copper's
but listen, it's still my favorite line, and if you don't want the line, I'm keeping it, because it's Dr. Copper's there. Because all you have to look here is on the London Exchange, on the LME. What you can see is copper is recovered and stable. The fact is that all we saw was COMEX volatility driven by tariff headlines. Copper here is on a global basis relatively stable. And what's interesting is that which one do you believe? So is copper on the LME stable, or the reaction on copper stocks was pretty nasty. They all took a dip. Like, the question is that if this was just putting tariffs on, pulling tariffs off, is copper a buy on dip with the fact that they slammed it this way? Like these copper stocks, sorry.
Well, I think the copper stocks, the difficulty is that there's different copper stocks in that index that have a certain amount of U.S. production versus non-U.S. production. And what you'll find is that as copper in the U.S. is gyrating around because of Trump's tweets, when he gets off the toilet that day, the reality is that these different stocks are moving differently. Like, you'll actually get days when copper in the US goes down and certain stocks that are listed in the US but still don't have as much US copper production rise. Yeah. So the problem about it is that you can't look at that index as a whole without thinking about it. And you are, Patrick, once again, very wise today. This is your wise day. You're absolutely correct that this copper in the US is a joke. It's in essence just getting jerked around by Trump's tweets. I did think it was interesting that was the largest one-day percentage move in copper ever. And you know what? I'm just upset because I had gone and, with some investors had committed, $5 billion to make a copper mine in the US because I wanted to allocate capital based upon Trump's, promise to tariff this. And then all of a sudden it got ripped away from me. So now I'm kind of like, I better stop the $5 billion of CapEx. And obviously I'm being facetious, but my point is this sort of volatility will not, induce people to make long-term allocations to U.S. Expansion in terms of CapEx. You can't. Think about it. Imagine you'd gone and it had thought to yourself, I'm going to go and I'm going to expand my copper production in the U.S. because Trump wants us to do this, because the reality is that he's going to tariff other stuff.
I'm going to push back on you. Okay. And my pushback is I think they knew all along that they're playing a game of short-term pain for long-term gain. They're playing this game like they know they're not going to be negotiating tariffs in 2027. They went and they said, "Look, we've got a red sweep in the thing. We have a chance to make meaningful global changes that we want, and we have a window to do it before the midterms." And they're basically, this year's is a tariff write-off. They're going to basically, and at some point in 2026, tariffs are just not going to be talked about because all the countries are either going to have accepted the tariffs that he's put on, or two, they're going to have negotiated deals, and we're going to go back to not talking about tariffs in a year. This is literally going to simply be something to define 2025, and it's going to go in the dustbin of history, and it's just Trump is just accepting this as in order to get what he wants, he's going to accept a certain amount of volatility. That's my opinion.
That is going to go down as peace in our time kind of speech, Patrick. We're just going to leave that one. We're going to clip that one, and we're going to go back to that in a year or two and see how that played out.
All right.
No other comment. We're just going to leave it at the beauty.
I'm just going to leave it and let it stew on its own. Yeah. You know what? I want to touch on.
Yeah, let's keep talking charts.
Yeah, let's keep talking charts. So natural gas has been very weak. I mean, we're in the seasonally low period of the summer. And, something like this continuous chart will be rolling up the term structure at some juncture here, going into winter gas. Overall, though, when you're looking at something like the 12-month strip using the UNL, it's been a pretty rough go for nat gas here, no matter where you are on the term structure. I ignorantly kind of felt that when oil prices are low and they're not pumping, that generally that tightens supply of the excess natural gas. And that just doesn't seem to have in any way manifested itself here. Like, are you bullish on nat gas in any way, or like, what's your thoughts? Because this is an ugly chart. Like, this is
Yeah.
brutal.
But so Patrick, I don't know in terms of nat gas what it's going to do over the short run, and the squiggles. We get one hurricane or some bad weather, and all of a sudden it changes. Longer term, I'm bullish because I expect LNG and that arb between international gas and North American gas to be narrowed, and ultimately I'm bullish. But short term, who knows?
Right. So I think we could leave a lot of the other commodities. We talked about a number of these things. One thing that I wanted to let's just go to the Mag 7s and let's actually talk about what's happened here on a lot of these earnings. Let's start off with the first wave. When Tesla came out, it kind of gapped down, but it wasn't a big market mover. But interestingly, Tesla has been more or less coiling up in a big kind of triangle formation, ready for the next move. And I'm curious if the whole market here has a little wave of selling. Does this send Tesla back down to its lows? And nonetheless, the technical setup on this is always whichever way it breaks out of the triangle is the direction of the next trend. And so we're going to get a really interesting tell here on Tesla. Do you have a bias on the stock?
Of course I have a bias, but I've cut myself off talking about Tesla because I've been so bloody wrong that eventually you have to just say to yourself, no, you're an idiot. You don't have a clue what really drives this, and that nobody is going to listen to you. So that is where I have put myself. I'm almost in a permanent timeout on Tesla.
I've been doing some income selling on Tesla and out of the money puts because of the high vol, and they've been working.
Oh God! You probably been buying them from me. Okay. Sorry, selling them to me.
Thank you.
I got that wrong. I got that wrong.
I appreciate the income. Thank you, sir.
Yeah.
The next one I want to talk about is Google. And so what's interesting is Google beat. It gapped higher. And this is actually, again, that thing that I'm talking about, which is that the first reaction being positive, and then the big money sells into the positive news. And you can see here that Google more or less has been selling off from those high gaps that it made on there. Now, if Google was to be in a corrective mode, so like it completed its measured move to the upside to perfectly, and when it did, it typically will retrace. And so if this retracement on Google plays out, notice the 50% retracement area is right along that 50-day moving average. Downside risk is another $8 down toward 180, where would be an interesting point to see whether it gets bought on dip at that level. But it is interesting, again, that it gapped higher and sold on the news. So then I wanted to talk about Microsoft on this. By the way, cut me off if you want to make.
No, you just keep going. You're the genius on.
But look at what Microsoft did. What was crazy was they were pricing in implied move of $25 higher and lower. This thing goes freaking ripping $50 to the upside on its earnings beat, and they have been selling ever since. Somebody said thank you very much, and some big player is just like getting all the shit off their books into that strength. Like, look at the relentless selling. It's not like what they said, they took it back or something. It literally is the sell on good news that comes with classic topping formations. I'm shocked that we've seen this type of a gap close. It's what in technical analysis they call exhaustion gaps, and this type of selling that definitely has marked some sort of a high for Microsoft.
Okay.
Now Meta though looks a little bit different. Meta was building a flagging formation into its earnings. So this thing here, so long as the gap doesn't close and what were its previous highs act as support, there's definitely room for like Meta to still make bullish runs up to 800 or 825. Looks way better than Microsoft for sure in this environment. I would, if I was to pick so far one of them to buy on dip, Meta would probably be the best out of the four we just covered. If I was going to buy any at all, but like this is the nicest looking setup out of them so far. Then we had Apple, which basically tried to rally on its earnings and just sold. What's particularly interesting about this was that the entire rally Apple had, first of all, it never participated on the upside with the other Mag 7s. And it stalled out below its fib zones, like right along its like 61.8 range, and creating this kind of wedging formation that has defined the entire consolidation off its low. And look at this breakdown. Like if this breakdown holds, if Apple couldn't rally during the bull phase, it's fucked. I'm sorry for like using the word, but like you don't buy the weakest one. Like the fact that Apple's breaking down this way is concerning, and I would generally be concerned about owning the stock without hedges. Like this is a very good candidate for putting on collars. You just put lock it in. If you insist on owning the shares and not selling, you should have some sort of a hedge on this, because like I said, Kev, like if a stock can't rally during an epic bull run, when the market sells, it's it can get hammered. It's not good for Apple. And the other one, Amazon, look at that gap down. First close below the 50-day moving average after it gapped higher on its earnings last go. Double top retest along the upside, gap to the downside.
Jeff
the Mag 7s.
Jeff's spending a lot. Like Jeff's wife's spending a lot of money, man. He's got to sell some stock.
He's got to sell some stock.
Yeah.
But what's interesting about this, Kev, is that these Mag 7 charts all look awful. And if this 5% buy on dip we're talking about manifests itself on the S&P, you have to believe that it has to be a broader sector rotation that is going to push the market higher, because the odds now that the Mag 7s are going to be where that flow is diminishing. Like I don't want to say it can't happen, but these charts look like they're all ready to sell. And so for me, it's like, will it be a sector rotation that really gets the market to have another run? It's like the puzzle to solve here.
Well, from your lips to God's ears about them getting sold.
Because the consumer staple stocks have been awful.
Yeah.
Like all of those.
Listen, everything except Mag 7 and all the tech kind of meme stocks have been terrible. Yeah. And that was, you mentioned the fact that the stock market pushed to new highs on, what was it? Yesterday? Yesterday morning. But to me, that was driven by those, few stocks that were such a large portion of the index, and the whole week felt terrible to me. You look at the small caps, they're trading like death. Like it's very clear that the market is becoming narrower and narrower, and that it's getting more and more risky. So like that's part of the reason of my bearishness.
So what I want to throw a bearish idea at you, based upon the fact that the Mag 7s are in this little high market cap bubble, on their own. Because when you look at the S&P 500 on an equal weight basis,
it looks terrible.
That was a double top retest.
Yep.
That and while I was looking for a double top on the S&P 500, what if this is a double top on the S&P 500 equal weight? Yeah, and what if that marks the market top?
Yeah, could very well be.
Right? Like it didn't think, and more importantly, middle America through the Russell couldn't get anywhere near its November, December highs.
Yeah. Oh, it feels terrible. Smalls feel terrible.
Well, the point is that if you weren't in the Mag 7s, it's like it's disguising like the bull market looks like thing, but it's like a dying patient that you just jammed up with adrenaline, the Mag 7s kind of juiced up all the market cap weighted indices, but when you look under the surface, the patient's dying.
Listen, buddy, you said it, not me, but I tend to agree.
All right, that's all I got, Kevin.
Okay, great stuff, man. As I said, 3 wise comments in a row. Like, holy smokes, that's our new record. Folks, before, thanks for tuning in. Where can they find more of these wise comments, Patrick?
You can find me at bigpicturetrading.com, but I'm getting a little bit of traction on my own little YouTube channel here, Kev. So anyone who
it went up once the cigar smoking went down. I think it's
so. You didn't.
I didn't like the cigar smoking. I must admit it. It felt very 1990s to me. Although it's probably going to come back. It's probably because I'm not cool enough. It probably is. Really
I got the vintage shirt from the 70s. So
that's cool. That's cool. I'm with that. And it looks great. Anyways, I'm going to tell people where they can find me. And they go to macrotourist.com and listen. Bear market, bull market. We're just happy you spend some time together on this ride. Now stick around for the after show. Okay, so we have no beer to recommend here. And we have Daniel trying to work the controls and having some real troubles. Is he going to come? There he is.
Yeah, there we go.
Yeah. Now, before we continue, the question really, like what is on everyone's mind is what Patrick thinks about the CIA running the financial, kind of financial system, and whether he thinks there's going to be a lot of O shocks coming in the coming days.
Fucking hell.
No comment. I reserve that for my paying subscribers who.
And I'm just having a look at what GPT chat says about this. But what do you feel about Jeffrey Epstein not as a scandal, but as a window on government-linked tech network and the flow of covert strategic research?
Cool.
But more importantly,
you're blowing my mind.
More importantly, how was the beer? Let's talk about Corona.
Oh, there we go.
No, we're not talking.
The guy who produces the other show just quickly is getting.
Let's quickly change the subject before.
Gosh, how crisp was that beer on a scale of 1 to 10?
It was not crisp at all.
Really, I actually like the Corona.
No, Corona's not bad. It's a nice summer drink.
Yeah, you know what? Although I disagree with the folks that put fruit in it. I really don't think you should.
What's wrong
put
with
fruit.
Lemon?
No,
I don't know. I just don't like it. I just feel like
citrus never hurts.
Yeah, no, I disagree.
Yeah, but it stops you getting scurvy for one thing.
That's right. The Englishman that was, going to take the boat across the.
So next week.
But 1 second, if that is the only thing that's going to stop you from getting scurvy is a little bit of lemon in your beer, you got real problems, buddy. I don't think it's going to solve it. Yeah. What about next week? What are you going to say, Patrick?
No, I'm just saying, like, you got any fun summer plans?
I have no fun summer plans, buddy. I'm just a boring
literally,
dude.
You decided to do nothing with the kids.
No, we're doing stuff, but nothing like big. No, I took off to England for a couple of weeks, and that was.
Oh, that's right.
Yeah, and that was work.
You didn't bring the family. That was a vacation from the.
No, I brought the wife though, so she had fun. While I was working, she was out having fun with her friend that was moving there, so that was fun. Yeah, we had a great time. As I said, I'm a huge fan, and I really enjoyed it. So that was my kind of summer trip. Awesome. Otherwise, I'm just going to try to go to all the different provincial parks. We bought a provincial park pass, Patrick. You'd be very proud of us.
So, would you do just hiking, biking?
Yeah, camping? We usually go, we hike, and then we, hang out at the beach. We try to find ones with beach. And I was up at Sauble Beach. I've never been to Sauble Beach. Went there for my first time.
Or you?
No, sometimes we do, but not usually.
Usually they're like 3-4 hour drives, right?
Yeah, but you just kind of get up early in the morning and then zip back.
Oh my God, that's so hardcore.
Not really. Well,
No, but I can't imagine at 8 p.m. at night after chilling out for an entire day and driving 4 hours.
That's because you drank 9 beers during that period.
Oh my God! Yeah, okay.
He's got a point, Pat.
How about you? What do you got planned for the summer?
Just The kids all fly into Lisbon next week. And
that's awesome.
So I'm gonna take them out to Italy, Slovakia, and then gonna rent a catamaran and do a big boat trip
that is
on the Greek
awesome.
islands.
That is awesome.
Yeah,
Going to the home country for a little bit, like just passing through.
And when you got the kids, got to see the family over there.
Yeah, and then you're gonna go. Well, that's awesome. So we're actually, for those who don't know, it's going to be interview only shows. So you can definitely tune in next couple of shows because it's going to be just me with a guest, and there's going to be none of this crap with Patrick and I.
Well, no, we'll push the next episode, the final episode, into the first week of September.
Oh, that's right. So it'll only actually be one interview,
just
only.
one episode.
Okay, well, listen, Patrick, I'm going to let you go. My kids will actually want to go do some cooking, and I stopped them from doing stuff. So, so everyone thank you for tuning in. Patrick, have a terrific time on your family vacation.
Thank you. Thank you guys.
And
we'll reconverge in September. We'll see what happens here.
And I will see you guys in 2 weeks for the guest only interview. Take care.
All right. Cheers, everyone.
Bye.